Welcome to Investors Insights. Our topic today, how about those credit cards? My name's Greg Powell, President and CEO of Five Plan Partners, and I am joined by my distinguished colleagues, Bobby Norman, Trey Booth, and Ty Miller. And we've just come out of our portfolio strategies meeting, looking at data from over the weekend, as well as looking down the road, how we have to navigate these markets and this economic data. Now, I want to point something out to you. Today is November 3rd, 2025. In 60 days, it will be January 3rd, 2026. We've got a lot of things going on, and we're going to keep you updated as we head towards year end. Now, Bobby, you really are the one that brought up credit cards, and I appreciate the discussion. Last vlog, if people want to go back and look at that, listen to it, you brought up some great things of different scenarios, indicators that we look at.
Yeah. I mean, look, as our viewers know, we talk about the good, the bad, the ugly. And as we start a new month, there are a few data points that we're slightly concerned about. So last week, like Greg mentioned, I shared that 3 out of the 8 of our leading economic indicators are showing concern. And one other concern we're analyzing is that you can see in this first chart is that U.S. credit card delinquency rate by 90 days or more is over 12%. You can see in this chart that the last time we saw this level of 90-day delinquencies was in the great financial crisis in 2009. So we talk all the time about how consumers have been spending at healthy levels and driving economy, but the question is at what cost? And one data point that we're watching closely, along with the delinquency rates, is the rate of firings or layoffs. The U.S. consumer has been able to stay healthy with a strong job market and incomes rising, but this could change if firings and layoff increase. And the latest layoff announcement report that you can see in this chart has stabilized after the big spike earlier this year, but that was mainly due to government layoffs. And we will be following this layoff chart closely in the coming months to make sure that the further increase in credit card delinquencies in combination with an increase in layoffs, because that could spell trouble for the economy and the market. So we'll continue to keep our viewers updated on the delinquency rates and the layoffs.
Yeah, and I appreciate what you said, good, bad, or ugly. We're watching it. So you have to react to all types of news and data, and we do it here at Five Plan Partners. And then Ty, I want to come to you next because you talked about the Fed announcement that we've just had and the rippling effect of that. So what's taking place there in relation to what Bobby's seeing on the other side?
Yeah, I'll bury the lead a little bit because I think Trey is going to hit on some of the Fed decision as well. But of course, we had a big Fed meeting last week. And one thing that I talked about in the previous vlog was we wanted to see quantitative tightening end. Now, quantitative tightening is something that the Fed has been doing since 2022 to combat inflation. And it's basically a reduction of their balance sheet. So think of they might have a 2-year treasury on their balance sheet. Those 2 years are up. Instead of reinvesting the proceeds, they kind of just let that bond mature or roll off their balance sheet. And that is a way to kind of keep the money supply down, because if they were going to reissue, rebuy a bond, they would have to give, the government money, and that would provide some stimulus. So quantitative tightening, they announced, is going to start ending on December 1st. And so what that means is anytime that these bonds start maturing, they'll start reinvesting the proceeds again, which is kind of a liquidity event for us, for the economy, which is, beneficial usually. We've talked about liquidity multiple times, usually beneficial for asset prices. And so how much is this going to be, a thing? How much is this going to impact things? Well, it's essentially going to be like another 25 basis point rate cut. You're probably not going to hear about it in the news. They're not going to say, the Fed's reducing rates by another 25 basis points or something like that. But this is essentially another rate cut. So it's pretty substantial when you think about it in terms of, going from a tight monetary policy to more of an easing policy. And then also maybe more on a consumer side of things, 2026 refunds tax refunds are set to be about $1,000 higher for each person than they were this year, which is up 43%. It'll be the largest since post-COVID. So, I know Bobby talked about credit card delinquencies and things like that, but we are seeing some positives on the consumer side with, an easing monetary policy, and then hopefully some more kind of stimulus coming back to the individual consumer via tax refunds.
Yeah, and so the news you're sharing actually offsets things that Bobby's talking about. And you're right, it's not only here within November and December of 2025, but there are things that are going to occur in 2026 as well that we're already looking at. So I really like the way the two of you bounced off of each other and debated those topics this morning. And I also need to add to our viewers that these are the topics we also share on our social media, on LinkedIn, Facebook, Twitter, Instagram, our podcast, on YouTube. So we are going to keep you updated as we go through this. But then, Trey, I want to talk to you for a minute because really appreciate all the research you had done. Yes, the Fed has made some decisions. And at the same time, it's a little hard to get some of the economic data with the government shutdown. So talk about that in relation to what we're watching at this time.
Yeah, thanks, Greg. Yeah, Ty is 100% correct. The big news out of the Fed was the ending of quantitative tightening. That was below the headline. The headline that the Fed gave was a 25 basis point cut, widely expected. No real news there. But the third, the third most important point that that the market really reacted to, didn't get a lot of coverage, was what Jerome Powell said, that the Fed is driving in the fog, is what he said. And so they could not predict what they would do in their December meeting. And the market reacted negatively to that, with interest rates going up and anticipating the percentage chance of a Fed rate cut in December dropping drastically. But to be fair to Powell, he's not wrong. We talked about this before the government shutdown occurred, that the biggest impact for nerds like us would be a lack of economic data that the federal government puts out. Now that has zero impact on 99.9% of Americans. But for the Americans like us that are watching this data day to day, and for Jerome Powell and the Federal Reserve, it's extremely impactful to not have that information. So it's only fair for the Fed chairman to say he doesn't know what they're going to do in December because he doesn't have the information to make a decision on what they're going to do in December. So I think the market's a little overreacting to that statement because he's just being honest that they are driving in a fog. But where there is no fog, now the macro data is foggy. We don't have a lot of good data coming out weekly or monthly. But where there is clarity is in the stock market, where private companies are issuing private reports on their earnings, and they have been strong. The S&P, 62% of the S&P 500 companies have reported earnings so far, and growth rate is coming in above. We talked about what we were looking for. We were looking for somewhere 9 to 10%. Growth rates are now exceeding 14%, with 10 of the 11 sectors beating pre-earnings season expectations. So where we don't have much macro data, the micro data on corporate America is very strong. And that's why you're seeing the stock market continue to do well in spite of what is seemingly very negative macro headlines, or lack of macro headlines altogether. The micro economy, corporate by corporate, when you add all that together, each corporation individually doing well, put that all together, that's your macro economy. And so if you can put all that together, we actually are seeing a very strong picture of U.S. economic growth from the corporate America. We may not be getting it from the federal level, but we're absolutely getting it at the individual level, and it's very strong. And so that gives us a good feeling about where the economy stands. Now, I can't say what Jerome Powell is going to do, but I can say the corporate America is doing pretty strong right now.
Yeah, and it also offsets what Bobby said at the beginning here in terms of the delinquencies and layoffs and firings that we've seen, and what Ty talked about in relation to you. That's some strong data that we have to watch. Very positive. So with that, folks, just know we're looking at both sides all the time, making sure that we're calling the right shots, and there are no guarantees, but we're navigating through as the data comes at us. The year is moving quick. The holidays are going to be upon us. We're going to keep you updated. And every day, just know that we're striving to see to it that our clients have better, richer, fuller lives. We appreciate your trust, your confidence in us, and also the fact that so many of you share this vlog with others. That has opened up doors for us as well. And for that, we're very grateful. Go and have a great week. We'll keep you updated, and we'll talk soon. Thanks.